Rubber meets the road. When someone comes along promising to double your money in just 5 years, the math says they absolutely must hit a 14.4% guaranteed annual return. And as the experts at Bandon Life point out, achieving that safely is incredibly rare. Honestly, chasing those unrealistic, compressed timelines demands taking on highly risky returns, which at the end of the day completely jeopardizes the very capital you're trying to grow.
Hey everyone, welcome to The Explainer. Today, we're diving into a topic that is universally appealing, but let's be real, kind of always misunderstood. We are talking about building long-term wealth, specifically the investor's guide to consistent growth. Look, almost everyone wants to see their savings grow. And hitting that milestone where your money actually doubles, it feels amazing. But all too often, that hunger for growth leads straight into the trap of those flashy get-rich-quick schemes. So today, we're going to strip away all that hype and look at the actual mathematical mechanics of consistent, sustainable wealth building.
Okay, let's dive right into this, because when people start hunting for answers, they usually run into some pretty wild promises. Guaranteed overnight doubling, zero-risk shortcuts. We really need to step back and ask, is there an actual mathematical secret to safely doubling your money? Well, the truth, at least according to the hard data, is that if your priority is safety, doubling your money isn't some heavily guarded secret at all. It is strictly a function of time, consistency, and making disciplined choices.
Here is our blueprint for today's explainer. We're going to cover the math of doubling wealth, the magic of compounding, safe investment vehicles, the power of diversification, and finally, building your consistent strategy. Section 1. The math of doubling wealth. Moving from myth to reality. To build a solid foundation here, we have to start with literally the most fundamental question you can ask as an investor. How long does it actually take to double your money? To figure this out without pulling up a massive, complicated spreadsheet, you really just need to know one specific number. 72. That's it. This is famously known as the rule of 72, and it is an absolute game changer of a mental hook. It lets you instantly calculate your investment timeline. Basically, it gives you a highly accurate estimate of how many years it's going to take for your initial capital to double, based entirely on your expected rate of return. Let's walk through the math using some data from Bandon Life. It's super simple. Step 1, identify your annual return. Step 2, you just divide the number 72 by that rate. Step 3, boom, you get your timeline. So if your investment is cruising at a steady 8% annually, you divide 72 by 8, which is 9. It'll take 9 years to double. If you're playing it safer with a more conservative 6% return, you divide 72 by 6, giving you 12 years.
So here is where the rubber meets the road. When someone comes along promising to double your money in just 5 years, the math says they absolutely must hit a 14.4% guaranteed annual return. And as the experts at Bandon Life point out, achieving that safely is incredibly rare. Honestly, chasing those unrealistic, compressed timelines demands taking on highly risky returns, which at the end of the day completely jeopardizes the very capital you're trying to grow.
Section 2. The magic of compounding, the eighth wonder of the world.
You're going to love this next part. A recent comprehensive study by IJORAR, the International Journal of Original Recent Advanced Research, analyzed Indian mutual funds over a 20-year horizon. And what they uncovered was a massive wealth multiplier of 4.23x. I mean, that is huge. But how do we even get to a multiplier that large when our human brains are naturally hardwired to only think in straight, linear terms? It all comes down to wrapping our heads around the difference between linear and exponential growth. You see, compounding is simply the process where your investment returns actually begin to generate their own returns. Short-term investments, they just give you a flat, linear progression. But when you look at the research, investments held for 10+ years create this massive exponential compounding snowball effect. It's undeniable proof that time in the market overwhelmingly beats trying to time the market. The IJORR data maps this progression out beautifully. At the 3-year mark, you're really only looking at a 1.15x multiplier. It feels slow, right? But the real magic of compounding, where it truly gets exciting, becomes distinctly evident after that 7 to 10-year mark. That is exactly when the returns begin generating their own returns at such a rapid rate that it accelerates exponentially, eventually snowballing into that huge 4.23x multiplier at 20 years. To put that into perspective, imagine you invest 10,000 rupees systematically every single month for 20 years. Over that time, your total out-of-pocket principal investment is 24 lakhs, but your final terminal corpus, in this study, an incredible 1.01 crore.
That means an absolutely astounding 76% of your final wealth comes purely from compounding returns, not your own pocket. Section 3. Safe investment vehicles, protecting your capital. Because obviously, you can't compound money you've lost to market crashes, right? So conservative investors wanting to protect their capital absolutely have to look at structured options. Based on data from Banton Life, Axis, and SBI, we can see exactly how predictable low-risk tools perform. Public Providence Funds, or PPFs, sit around 7.1%, which doubles your money in about 9 to 10 years. Fixed deposits and fixed income funds hover in the 6 to 8% range, taking 9 to 12 years. Even insurance savings plans offer steady 6 to 7% returns, with the added bonus of life cover. Now look, are these going to double your money overnight? No way, but they steadily, predictably do the job without exposing your hard-earned cash to crazy market fluctuations.
And if you're looking to mix up stable instruments, Motilal Oswal actually outlines several bond types perfectly suited for this. You've got government bonds, which are essentially risk-free. I mean, unless the government entirely collapses, in which case your investment portfolio is definitely the least of your worries. Then there are corporate bonds, offering a slightly higher yield if you're okay with a touch more risk. Tax-free bonds protect your interest from income tax completely. And sovereign gold bonds, they actually let you invest in the stability of gold while earning interest on top of it. It's a win-win.
Section 4. The power of diversification, reducing your risk.
Now, holding safe assets is really just one part of the puzzle. How you mix them together is where the true protection lies. To understand why this is so critical, we have to look at how SBI Securities breaks down risk. They say there are two types, systematic and unsystematic. Systematic risk is general market volatility, like a global recession, and honestly, it's pretty unavoidable. But unsystematic risk, that's specific to a single company or sector. Since we can't avoid those systematic market drops, we have to use diversification to completely neutralize the unsystematic risks. Basically, if one sector tanks, your whole portfolio shouldn't be going down the drain with it. So how do we actually do it? Well, SBI Securities advises diversifying across multiple axes. First, you diversify across asset classes, so mixing equity, debt, and gold. Second, across market caps, blending the steady large caps with those growth-focused mid and small caps. Third, within debt itself, you diversify across tenure, mixing short and long-duration bonds to protect yourself against fluctuating interest rates. And finally, across themes and sectors. By mixing assets that have low correlation to each other, you practically guarantee that you always have outperformers propping up your portfolio, no matter what the economic weather looks like outside.
Section 5. Building your consistent strategy, turning knowledge into action. All right, we've got the math, we know the vehicles, and we fully understand diversification. Now let's turn all this theory into a concrete, actionable plan you can use today. Building this strategy comes down to 3 clear steps. Step 1. Define your target amount and deliberately align your time horizon with your actual risk appetite. Step 2. Start early and automate your investments with systematic investment plans, or SIPs. The IGRR study proved definitively that disciplined automated monthly contributions drastically reduce the urge to try and time the market. And Step 3. Review periodically, maybe just once or twice a year, simply to ensure your portfolio hasn't drifted too far from your initial asset allocation.
Honestly, if you want a brilliant summary of the whole philosophy we've talked about today, look no further than CFA Rick Ferry's Rules for Serious Money. 1. Save 20% of your income. 2. Diversify across a wide spectrum of index funds. 3. Maintain a consistent asset allocation and absolutely do not try to time a market. And 4. Implement a sound tax strategy. As Ferry points out, these 4 simple, frankly kind of boring rules will add way more wealth to retirement savers than any flashy, complex product Wall Street is trying to sell you. And I really want to highlight this powerful quote from Ferry. Truth must be repeated again and again, because error is constantly being preached around it. In the world of finance, the errors being preached are the constant, daily noises of get-rich-quick schemes and overnight stock tips. But the truth is the quiet, undeniable, mathematical power of compounding. So as we wrap up this explainer, I want to leave you with one provocative question to ask yourself the next time you look at your own portfolio. Are you trying to time the market to chase unrealistic returns, or are you actively giving your money the time it actually needs to grow? Trust the math, trust the patience, and just let compounding do the heavy lifting for you. Thanks for joining me on this explainer, and I'll catch you